All right, good morning, everyone. Welcome to our presentation on 1031 exchange basics. We'll be talking about how to sell without paying taxes. This event is always one of our most popular because, let's be honest, who loves paying taxes? Um, Joining me this morning, I have Dino Champagne, our amazing 1031 preferred accommodator. Dino and I work together on a regular basis, helping our clients save money. She's fantastic. She's super resourceful in our network, and you guys are in for a great treat. So, a little bit about me. For some of you, I haven't had a chance to meet yet. I'd like to take a quick moment and introduce myself. My name is Evan. I'm a realtor and advisor here in Newport Beach. I was born and raised in South Orange County. I've conducted over 100 plus million in real estate transactions. I also own multiple investment properties for myself, ranging from single families to fourplexes. And now, with that out of the way, let's dive into the nitty gritty. So let's take a moment and kind of just go over what Marshall Reddick is and what we do. We are a full service real estate firm focusing on three primary divisions. Obviously brokerage, so we help clients buy and sell, whether that be their primary or their investment properties. We have several offices in Austin, in Texas, and San Antonio, also in Southwest Florida, and then in Clarksville, Tennessee as well, in Nashville area. So we specialize and help clients in their selling primary residence and investment properties as well. But also we quickly realized that a lot of our client base have really no interest in being a landlord. So we tried to help that, and so we do property management in each of our locations as well. So we offer a full staff and property management team, and with being on Marshall Reddick markets. And lastly, we do private lending. So we have two clients in that division. We have the borrower side where they come to us looking for money, and then on the flip coin, we have clients that want to put up money and make a money on their, or make a percentage on their money. So our markets, we are in 16 major metropolitan markets across the US. All of our markets you see here within the green boxes are actually Marshall Reddick direct markets. The vast majority of our investors prefer 1031 their sale proceeds into one of these highlighted markets. They continue working with Marshall Reddick in their up leg purchase property, and also help us, or they use us for their down leg selling the property. And we have Dino here that will obviously explain how to do so you're not paying a ton in taxes. Our clients choose us knowing we are there to be their advocate and helping them every step of the way. Marshall Reddick is also extremely beneficial in working with us in our resources and how we pick and handpick our markets. And how we do so, every investor I've worked with wants to know how we are doing and how we are choosing where we want to invest in our markets. That is an excellent question, and Marshall Reddick has been around for over 40 plus years, and we've sold over 200, or actually, yeah, 200 plus properties in every city so far. But we choose the top markets to set up our offices in. Our benchmark and what we look for is obviously a strong and stable job market and low vacancy rates, and also a thriving economic diversity, and obviously just having in-house reliable property management. So it is now my pleasure to introduce you to my friend and partner, Dino Champagne. Dino is an incredible asset to our clients. She has vast knowledge of all things pertaining to 1031s. She's kind, she's funny, extremely sharp, and saves our clients a ton of money. So without further ado, Dino, you have the floor.
Very good. Let's see. I'm not sure if I can hold up to that funny stuff when you're talking to a blank screen. Anyway, thank you for having me, Evan, on this webinar this afternoon or this morning, whatever, depends on what time zone you're in. I just want to give a little bit of a detail as to my background with asset preservation and who we are as a company, and then we'll dive into the 1031s. Yeah, I've been associated with the Marshall Reddick Group since I joined asset preservation back in 2002. So I've been with the company for 19 years. Asset preservation is a national 1031 qualified intermediary, and we're a subsidiary of Stewart Title. That's our parent company. We have facilitated as a 1031 company over 200,000 exchanges nationwide. So as I like to say, this is our skinny lane in the highway. I've been doing it, as I said, for like 19 years. Prior to that, I was a commercial broker. Prior to that, I was a commercial banker. And I could say I started when I was 2, since you don't see my face, you can visualize whatever I look like, very young. Anyway, okay, so what we're gonna talk about today in the 1031s, I'm gonna give you an overview of like what the capital gain tax rates are, other tax issues associated with investment property. When you're doing a 1031, there's certain criteria you have to meet, such as getting like-kind property. So we're going to go through what is like-kind property, what's the, how much do you have to spend? We call that the exchange equation. I'm going to take you through the format of the exchange, so the process, the identification rules, highlights and such of what we see in the industry. And then I'm going to cover some miscellaneous issues that are coming up in the 1031 arena itself. We have questions and answers at the end. I'm sure you can just type them in. We'll address that when we get to the end of the program. Okay, so let's talk about the capital gain taxes. When you're selling investment property, you're going to be subject to potentially 4 different taxes. The first tax is going to be, you've got the capital gain tax rate, which right now is 15% or 20%, depending on what your income is. If your income is more than $445,851 as a single tax filer, you're going to be subject to 20% capital gain rate. If you're a married couple filing a joint return and your income is more than $501,600, again, 20%. If your income falls below that, then you're going to be at the 15% long-term capital gain rate. I'm going to address at the end the proposal and how the Biden plan is going to have an impact on capital gain rates and potentially 1031s. There's also a tax known as the net investment income tax. Most people would go, what is that? Well, the net investment income tax basically is what's known as the Obamacare tax. If a taxpayer's income is more than $200,000 as a single tax filer and $250,000 as a joint tax filer, then if your income is more than $200,000 or $250,000, you're going to be subject to an additional 3.8%. And then there's the recapture tax, okay? When you own investment real estate, you're depreciating the property. So when you go to sell the property, that has its own tax rate of 25%. So at the federal level, you can see we have the capital gain rates of 15 to 20%. You have the recapture tax of 25% and potentially 3.8% for the net investment income tax. Now, if you're in a state that has income taxes, such as California, you're going to be subject to your state income tax. And right now, throughout the country, that ranges anywhere from 0 to 13.3%. California has progressive tax from 9.3 to as high as 13.3%. So when an investor is thinking about selling an investment property, those are the tax rates that they're going to have to consider that they may be paying on the gain on the sale of the property. So an easy way to look at this, because a lot of times folks come to me and say, well, how much am I going to pay in taxes? Well, let me just get my little disclaimer out of the way right now. I do not, cannot, and will not give tax and or legal advice. Now, you need to speak with your tax person to determine what your actual gain is going to be, but you can sort of ballpark a little bit that you can figure maybe somewhere between 30 to 35%, okay, of whatever your gain amount is what you're going to be potentially subject to in taxes. Now think about that. If your gain on the sale of a property is $100,000, $30,000 or $35,000 is going to go to the federal government as well as to any state authorities, taxing authorities. And, you know, so fortunately, we have a 1031 tax code, which I have to tell you, 2021 is our 100th year anniversary because they've been around since 1921. So you have the option of deferring these taxes, and instead of giving the tax to the IRS and towards the local state, to the state, you can use those funds and buy more property, basically to continue your ownership in real estate and then take advantage of the code itself. Now, in any type of transaction, there's always going to be pros and cons. So let's talk about the benefits when you're doing a 1031. Well, one of the biggest benefits is you get to defer the recapture tax, the federal capital gain rates tax, state taxes, net investment income tax. Now, we'll say at the state tax level, you want to make sure that when you're looking at the state level, you find out, does that state comply with the federal code for deferring any capital gain taxes? There's one state that does not, has elected not to. There's some states that have some restrictions that say if you sell in my state, you can defer the tax for our state, but you have to buy in our state. So you always want to make sure at the state level, you want that how that state is treating the 1031. I have to tell you, a vast majority of them mirror the code. Okay, just a small handful may have some slight nuances to it, but you get to defer the tax. Another advantage for doing a 1031 is that you're preserving equity. Okay, so you're building up your wealth as an investor. What we mean by preserving equity is we're referring basically with this statement to saying that I'm not paying the taxes, I'm deferring the taxes, therefore I have that additional cash to buy more property. I can also utilize the 1031 code as through leverage. Now, you may be an investor that has owned the property for a period of time and maybe have either a small or no loan on the property. When you buy your replacement property, you can utilize leverage to increase and enhance your portfolio. So that's another advantage to doing a 1031. Diversifying. People right now are diversifying definitely geographically as well as potentially asset classes. I'm working with some folks right now that are selling raw land. And they're wanting to buy income producing properties such as, you know, single family rentals or a duplex or fourplex. People are diversifying geographically, definitely. In California, we're seeing some people leave California, so they're selling their California assets and they're going into other states where there's more cash flow, where they can get a little bit more for their money. So you're able to diversify geographically. And then there's also the long time ownership advantages right now to 1031s, and that's under the current tax law. If you end up doing an exchange and exchanging your entire life, when you pass away, your heirs will inherit the property, and under current law, you will get a full step up in basis. So folks have utilized 1031s also as a potential estate planning tool. Now, I will put a little note on that. With the President Biden's current plans, they're looking at potentially eliminating the step up in basis. So we're watching that very, very carefully, and so should you guys, to see what's coming out of this proposal. And I want to focus on the word proposal. So those are the advantages of doing a 1031. Now, with every pro, there's going to be a con. So let's talk about, you know, the downsides when you do a 1031. Well, one of the downsides is there's these rules and time frames that you have to follow. So very specific. I'm going to go through all of those as we go through the process here. Another downside to doing an exchange is you don't get a brand new basis in the property. So if you were selling a property, paying the tax and buying a property, you would have a new basis in the property you're acquiring. But when you're doing an exchange, your old basis will move with you to the next property. So as an example, if my basis in the property, which is basically what that means is what I originally paid for the property, plus any capital improvements I've made throughout the course of ownership, minus the depreciation, is going to give me my net adjusted basis. So say, for example, I've done all the calculation and my net adjusted basis is $200,000 and I'm selling a property for $500,000. that means my gain is 300,000. If I were to buy a property for 500,000, my new basis in the property is not 500,000. It's 500,000 minus the gain deferred, which was 300,000, which brings me to my original basis. So when you're doing an exchange, if you're buying property that's the same value that you sold, you do not get a new basis in the property. So that's one of the downsides to the exchange. Also, a downside is called lack of liquidity. Why? What do I mean by that? Any cash you keep, you'll pay tax on. So all the money coming out of the sale needs to go buy real estate, investment real estate. If there are any losses, you cannot recognize those losses. So it's very, very important when you're considering doing a 1031 tax deferred exchange that when you're making these decisions, one of the partners that you're making this decision with is whoever does your tax returns, because you want to make sure that you need to, or doing a 1031 is going to be beneficial to you based on what your overall tax position looks like. So always consult your tax advisor to determine, do you need to do an exchange and should you do an exchange? Possible risk of higher taxes in the future. That's certainly on the horizon because that's another part of President Biden's tax changes that he's trying to propose. And again, 1031s are tax deferred. They're not tax free. So all you're doing is basically pushing aside the deferral and the gain. Now, let's talk about those basic requirements, some of those rules that you have to comply with in order to defer the gain on the sale of the property. Well, one of the most basic is the property qualifications. When you're doing an exchange, it's an exchange for real estate, okay? So if you have investment real property or real property that you've held for trade or business, then that means you can qualify for a 1031. So that's one of the basic requirements. It has to be real estate that was held for trade or business or for investment. And we're going to fine tune this a little bit later. The next basic requirement for doing a 1031 exchange and deferring the gain is how much you have to spend. So you have to spend all of the cash coming out of the sale, and you have to replace any existing debt. So if you keep focused that you need to purchase property or properties equal to or greater than your sale price, net the closing cost, and spend all of the cash, you're going in the right direction to know that you're meeting one of the basic requirements for doing a 1031. Now, the next requirement is going to be, how much time do you have to complete this transaction? Well, regrettably, we don't have forever. Again, one of those cons, right? You've got these basic timeframes that you have to comply with. The time frame for the exchange is going to begin when your sale closes. You have 45 calendar days from the date of the closing to identify any property or properties that you would like to purchase. You have to finish your exchange within 180 days, again, from the date of your sale closing. So another way to look at this is that you need to identify 45 days after the date of closing, and you have an additional 135 days to complete your exchange. So the exchange period from beginning to end is 180 calendar days. Notice I'm focusing on the word calendar. It's not business days, it's calendar days, okay? And then the fourth requirement that is necessary for the compliance of an exchange is you have to identify the property or properties that you would like to purchase as a part of the exchange. Now, we're going to go through all four of these basic guidelines right now. Okay, so let's go to the first one. When we talk about property, real property that's held for trade or business or for investment. So you've heard the term, I must buy like-kind property. Well, as you can see by this colorful picture here, like-kind property is very broad. So it's not so specific that it's land for land, or a single family home rental for a single family rental, or an industrial building for an industrial building. It's basically investment real estate for investment real estate. That's how broad it is for like kind. Has to be real property, but it has to be property that's held for trade or business or for investment. So you're not limited if you're trying to get out of something, that a property type that you don't want to be in any longer, to having to stay in that property type. So for example, if I have a retail shopping center and I don't want to have a retail shopping center anymore, and I want to go into something like single family rentals or an apartment building, I can easily do that. Or if I have an office building, I can trade for an industrial building. Very broad when we talk about property that's like-kind property in a 1031, okay? So hopefully that makes some sense to you. One of the things, just so we're clear, is you cannot exchange your primary residence, okay? That's not a part of the 1031 code. The primary residence is its own code. That's IRC section 121. So if you have a property that you're living in, it's one dwelling that you're living in, and say, for example, your gain exceeds the exclusion of the 250 or the 500,000, you can't do a 1031 for anything above that, okay? Because you're living in the property, the last use of that property is a primary residence. That does not qualify for a 1031. It also works on the flip side. So if I'm selling an investment property and I want to buy a replacement property that I want to move into immediately, that does not qualify for a 1031. All right, so be very specific. If it's your primary residence and you're selling, it's not a 1031. If you intend to buy your primary residence in a 1031, that does not work. Now there's strategies for later, but you cannot do it immediately. Okay, so very specific when we talk about like-kind property. Now let's go to the second requirement we talked about. How much do you have to spend in order for you to meet the requirement for an exchange? So here I have some examples. If I am selling a property for $900,000 and I have a loan on the property at the time of the sale of $300,000, I'm going to have some closing costs, okay, such as the commissions, the escrow fees, or the attorney closing fees, title fees, transfer fees, and such. And let's just say that that cost of sale is $60,000. That means I have $540,000 in cash. So to try to defer 100% of the gain, I need to purchase property of equal to or greater than. So if my replacement property is $1.2 million, I acquire a loan of $660,000 because I'm putting down the full $540,000. In this example here, I will have met the criteria of deferring the gain on the sale of the property. I spent all of my cash, I replaced the existing debt, and I bought equal to or higher than what I sold for. Okay, so that's the exchange equation. You can do this by buying not just one property, but you can buy multiple properties that will equal what I sold for. So if I sold for $900,000, I could theoretically buy, say, three $300,000 properties and meet the same requirement. Okay, so it's not just one for one. You can buy multiple properties. You'll see that a little bit later in the slides. Now, sometimes people ask, well, what if I wanted to do a partial exchange? Can I do that? And the answer to that would be yes. It's the good thing about a 1031, it's not an all or nothing system, okay? But when you're considering doing a partial exchange, it's really important that you do the analysis to make sure that you're still benefiting from the exchange itself. So in this example here, where I'm selling for my $900,000, but I'm choosing to buy only one property for $700,000. I acquired my loan of $300,000, so I've met the debt requirement. I only spent $400,000 because that's all I needed to get the $700,000 purchase, but I didn't spend all of my cash. So we have here in this example, $140,000 of what's called cash boot. So when you hear accommodators, qualified intermediaries talk about boot, we're not talking about shoes at Nordstrom's, okay? We're talking about taxable. So one way to equate the term boot in a 1031 is it simply means taxable. Now you have two types of boot, mortgage boot and cash boot. My example here is showing me that I have cash boot. Now, when I said that you need to make sure that you're looking at whether it makes sense or not to do the exchange when you're taking some boot out, okay? That means that if my gain on the sale of the property is either equal to or higher, I should say higher than my actual boot, to the level that it's higher, I'm benefiting from the exchange. So for example, if my boot on this example here is 140,000 and my overall gain on the sale of the property, so in other words, when I went to my accountant and found out what's my gain, what's that dollar amount, and my accountant says your gain is $200,000, then that means I'm still benefiting from the exchange because I am protecting tax on the $60,000. But if my accountant said my gain is only $100,000 and my boot is $140,000, I'm not benefiting from the exchange because my boot is higher than the actual gain that I would pay in taxes. So I'll pay the tax on the $100,000 like I did nothing. That's why it's so important to make sure that when you're dealing with a partial exchange, that you're asking, you're finding out what's my actual gain on the sale of that property, okay? All right, next thing, let's talk about closing costs because this comes up all the time in a 1031. What are considered acceptable exchange expenses and what are not? Well, when you think about a transaction and where you're transferring property, those are considered acceptable exchange expenses. So real estate commissions, title insurance, closing fees, legal fees associated with the transaction of the property, okay? Transfer fees, notary fees, recording fees, the qualified intermediaries fees. What's not considered a part of the exchange? Prorated rents and security deposits. So for example, if you're selling a fourplex and you have prorated rents and security deposits, a lot of times I'll see in contracts where the sellers and buyers have negotiated that the seller selling the property is going to credit the buyer for the prorated rents and security deposits. So if the prorated rents and security deposits come to say $20,000, that's $20,000 less that the buyer is bringing in. That's why it's a boot issue and would be taxable to somebody doing this in a transaction. You just have to know that that's going to be a taxable event. Other costs of doing the transaction that are financing related, points, prepayment penalties and such. Those types of fees are the cost of buying money to buy the property, not directly buying the property. So when you're dealing with points, prepayment penalties and such, those are considered potential boot issues if you're looking at in an exchange transaction. Paying the buyer's closing costs, we see a lot of that. If you're paying the buyer's closing costs, and that's potentially another boot issue. I like to say when you're looking at these issues, you want to run it past your tax person because then you can see, well, am I going to be able to offset this? For example, offset paying the buyer's closing costs. Maybe your accountant's going to go, well, yeah, it's a boot issue, but it's an expense over here, so we can negate some of the taxes on that. I like to say that's the backdoor stuff where the accountant figures it all out. Other costs that you may incur on a transaction: lender fees, impounds, property taxes, and insurance. I'm seeing more often now that where lenders are requiring impounds, and they're requiring, and when you're buying the new property, they're looking for at least 3 months of the impounds that they collect at the time of the closing. If you're using, if you're not bringing in that money, then and you're using exchange proceeds for that at the closing, then that's going to be a boot issue because that's a cost of operating the property and not a cost of acquiring the property. So always consult when it comes to closing costs. Now, there's times where people have to fix up the property and they go, well, is there any way I can be reimbursed? And the answer to that is no, not without it being taxable. Could it be offset? That's up to you and your accountant on how you're dealing with that, okay? These are the items that you have to, be sure that you understand how this plays out in a transaction. Okay, now let's talk about the exchange itself. So when you're doing an exchange, okay, you're electing to do a section of the tax code, IRC section 1031. So when you're listing the property for sale, as I said, you want to talk with your tax advisor to make sure you need to or should do an exchange, okay? You want to talk to a qualified intermediary because we're going to have different conversations. I'm going to be talking about what you can expect throughout the exchange. I'm going to be asking questions. Well, how's the tax ownership to the property? How much do you plan on buying? Where are you planning on buying? These are the conversations I'm going to have, explaining what to expect in a transaction. And then once you make the decision to do that, once you're under contract with the buyer, then you have to make sure that the contract's assignable. We get assigned into the contract prior to the closing of the sale. So you cannot set up an exchange after you've closed on your sale. This must be done before your sale closes. Our documents have to come in, okay? We're going to have the intent to exchange language. We're going to have, there's language in there that releases the buyer from any liabilities associated with that. We're notifying the buyer in writing that we're being assigned into the contract. We're going to have restrictive language in our documents, which all comply with the tax code. Okay, so you're going to have to understand that once your escrow closes, you're going to have to identify what you're going to buy in the 45 days, and you're going to have to complete your exchange by the 180th calendar day. There's another component to that, which is your tax filing date, whichever is earlier. We're not at that right at this moment because we're not toward the end of the tax year. So you want to make sure that you're getting your exchange set up prior to the closing of your sale. If you do not do that, you do not have an exchange. Now, what happens is we get assigned into the contract as the qualified intermediary. So we take over your role as the seller of the property. We're going to prepare exchange documents. Those documents are going to go out. You sign the documents. When the buyer brings in their funds and the escrow closes, the closing takes place, the deed is going to go directly to the buyer. See, while we're become the seller, we never go on title to the property in a forward exchange. When the deed goes to the buyer, the money comes to the qualified intermediary. Now that's when, not when we receive the money, but when the closing took place. So just be very clear on that. When the closing takes place, that starts the time frame for the exchange. So there's, as you see below, you've got the 45 and 180 days all starting at the same time. When you get under contract with your replacement property, we prepare the exchange documents on the buy side. When you're ready to close, we wire in the funds to the closing. When the closing takes place, you're on title to the property. So as you can see, this is the flow of the exchange, okay? We have to have exchange documents prepared before the closing of the sale. We prepare the exchange documents when you're ready, once you get under contract with your purchase, when you're ready to close, we're going to wire in the funds, and then the deed is going to go, you're going to go on title to the deed at the closing of the sale. That's the flow of the purchase, I should say. That's the flow of the exchange. Now, let's talk about the fourth requirement, which is the identification. In order for your exchange to be a valid exchange, you have to identify what you're going to buy by midnight of the 45th calendar day from the date of closing. Now, if that 45 days falls on a Saturday or a Sunday, you still have to identify by that date. Same like if the 180th day falls on a Saturday or Sunday, you need to close the Friday before. Because you can't close the Monday after. Now you're outside of that time frame. All right, so be aware of all the moving parts. Now, there are 3 identification rules that a taxpayer can utilize when doing an exchange. So let's cover that right now. The first rule, which is the most commonly used rule, is the 3 property rule. Under the 3 property rule, you can physically identify 3 addresses, but you are not limited to dollar amounts. So if I'm selling for, say, $500,000, I can identify a property for $600,000. I can identify a property for $545,000. I can identify a property for $650,000, and then decide to buy 1, 2, or all 3 of those properties. I have no limitation to the dollar amount. But if I say, well, gee, I want to identify more than 3 properties. I want to identify, say 5 or 6. Now you've moved from the 3 property rule into the 200% rule. Under the 200% rule, you can identify 4 or more properties, but the fair market values of each and every one of those properties added up cannot exceed 2 times or 200% your sale price. So if my sale price was $500,000, I can identify 5, 6, 7 properties as long as those values does not exceed $1 million. So people will say, well, I'd really like to buy, identify more properties. When I have a conversation with people doing an exchange, I'm going to ask, well, where are you selling? Okay, well, I'm selling in Southern California for $500,000. Okay, where do you want to buy? And if they tell me they want to buy in Southern California, I'm going to say you're in the 3 property rule by virtue of the values in Southern California, for example. Okay. But if they're telling me I'm selling in Southern California for $500,000, and maybe I want to buy a property in Tennessee or in Florida or Ohio or somewhere else where the price points of entry are a lot less for buying single family rentals, then maybe I could go into the 200% rule, because the aggregate values could be, still be within the $1 million. Okay. But if I got carried away and wanted to identify, more than 3 properties, but the values exceeded the 200%, now I'm moved out of the 200% rule and into the final rule, which is the 95% rule, which basically means that I have unlimited number of properties, unlimited dollar amounts. But before you get excited about that rule, it's third for a reason. You have to understand that in order to meet the criteria for the identification, you have to close on 95% of the total value of all of the properties I've identified. Okay, so you have to basically buy your entire list. That is a rule you do not want to go toward, and if you do, you better feel very, very comfortable that you're going to be able to complete that in time. You get all of these properties under contract. So when we talk about there's no limit to how much you can buy in a replacement property, more is good in an exchange. You need to watch which identification rule you're going to be able to utilize and have a successful exchange. So for example, I had a client that was selling a property, had 0 debt on it, for around $400,000. They wanted to utilize leverage to the tune of 25% down. They were buying properties in, I think they were in like Florida or North Carolina, somewhere like that. And they were going to be utilizing the leverage. They wanted to only put 25% down on all of these properties. Well, if you're selling, say, for $400,000, and now you're putting this much leverage, theoretically, you could end up buying properties that, could be valued at about $1.6 million. So that tells me already that person's gone from the 3 property rule to the 95% rule in a heartbeat. They have to make sure they're going to close on every one of those properties. So when you're thinking about how aggressive you want to get with leverage, just watch which identification rule you're going to be utilizing in an exchange. These are some of the moving parts that happen well beyond, a webinar like this. Okay, just keep that in the back of your mind when you're dealing with these kinds of issues. Okay, now let's talk about other things, because people are selling multiple property exchanges and they're trying to consolidate. So I have a few of those transactions going on right now. You have to understand that when you're trying to consolidate and sell, like you say, multiple properties to buy one property, your time frame for the exchange is still the same for all 3 properties. So the bottom line is, when that first sale closes, that is dictating the 45 and 180 days for properties 2 and 3. Okay, if you're selling 3 to buy 1. So you want to make sure that all of these properties are closed, because you cannot close on your purchase until that final sale has closed, and you have to identify what you're going to buy within the first 45-day period of the sale, the first sale closing. These are a lot more difficult to achieve, but just understand that it can happen. You just have to watch the timing of everything. And then what we see a lot of right now, for sure, is somebody selling one property and buying multiple properties, okay? So in this instance here, when you're doing that, you can deploy your cash any way you want. You can maybe put more money down on one property. It's not something that has to be divided equally. So if I'm holding as a qualified intermediary 300,000 and you're buying 3 properties, you don't have to say 100,000 down on each property. You can split up your money any which way you want. You can finance it any which way you want, as long as you end up meeting the exchange criteria of spending all of your cash and replacing the debt. Okay, so this is how multiple property exchanges work. Now, it's important to understand that you have to finish your exchange and that last purchase by that 180th calendar day. Okay, so now let's go over some issues that we're seeing in the marketplace today. Anybody that's been paying attention, and I'm sure that's everybody on this that's listening to this, you realize that it's great to be a seller, okay? Because there's very low inventory. So you're in the catbird seat when you're a seller. But when you're doing an exchange, you're in the catbird seat for a while, and then soon you're about to be the bird, okay? Because there's a lot of low inventory. So there's a lot of strategies that you have to put in place when you're starting to sell, when you're thinking about selling your property. So when you're talking to Evan or someone out there about, I'm going to be selling my property, I want to, where am I going to go? What markets am I going to go into? You have to see what's the inventory for that area, where you want to be, so you have an idea of what you're going to be going into. Now, there's a lot of new construction that's going on, and I will tell you some of the issues that come up with new construction and 1031s. And that is that there have been delays in the completion of the new construction. So if your timing is not right, you may not be able to finish your exchange because the construction is not complete by the 180th calendar day when you have to complete your exchange. So strategies for that might be that if you're waiting, because it's a seller's market, you may wait to put your property on the market for sale, lock up new construction where you put your deposit down where they're starting to build it, when they're probably halfway or far enough along where it's going to be completed. Then you put your property on the market, and then when that's sold, then you're not stressed out that you're not going to be able to buy this new construction as a part of an exchange. So if you're looking at new construction, be very, very aware of when that's going to be finished and factor in delays, okay? Delays for supplies, because that's been a huge issue. And also, depending on where you're buying and where they're building, you may have weather delays, okay? Another part of the exchange to be aware of is that when a taxpayer is doing an exchange, the same taxpayer selling must be the same taxpayer purchasing. So these are issues that need to be addressed when you get ready to sell your property, okay? So as a taxpayer, how am I holding title to the property? How am I reporting this property on my tax return, okay? So if I'm an individual, if they have, say a married couple, for example, they hold title to the property and the property is held in their individual names. They want to buy the new property in an LLC, but the married couple, say, lives in Florida. Well, they can't create one LLC where the husband and wife are the members of that LLC, because Florida is not a community property state. They live in Florida. So by default, they're going to be in a partnership, but they sold as individuals. That will not work for an exchange. But if they're a California resident, husband and wife, and they're buying into an LLC, they can, they want to buy in an LLC, they buy the property in an LLC, as long as they treat that LLC as a disregarded entity, then that would work for the exchange. So when somebody's doing an exchange, we as qualified intermediaries, we're monitoring same taxpayer selling, is that the same taxpayer purchasing? Okay. Sometimes people may own a property in an LLC taxed as a partnership, say a husband and wife, for example. and they're buying 1 to 4 properties, okay? And they go, and most lenders say, well, we don't lend to partnerships in a 1 to 4. Now your lending is becoming very, very restrictive. You cannot buy in your individual name and then put it back in the LLC, because you're not buying in the same tax entity you sold out of. So knowing this in advance helps you solve these problems that could come up in the middle of an exchange transaction. Financing. Very important that when you're working with your lenders, that your lender, first of all, knows how much you're putting down, that you're getting, that this financing can be done in a timely manner to facilitate your exchange. And I think that some of the financing issues need to be addressed very, very early on. So when your property is under contract for sale and you're looking to find the replacement property, in my opinion, you should already be talking to a lender to find out how lendable the situation is, how much you're going to have to put down, all of this, because this is going to be a very important component to being successful in the exchange transaction, okay? Also, I think it's important that when you're embarking on these situations, that as an investor, you have reserves outside of the exchange to pay for costs that are going to come up during your acquisition period. For example, when you're out there buying a replacement property and you get under contract, what you're going to do is you're probably going to have an inspection, okay? If there's financing, you're going to have an appraisal done. Most of these items are, the vendors are not waiting until your sale closes, okay? So that has to come up front. So the qualified intermediary is not going to be giving Ivan the inspector or Alan the appraiser their fee, you know, with our exchange proceeds. Our exchange proceeds are only going to be wired into escrow for the closing of the purchase. All right, so be very, very aware and have reserves, so that way you have these funds available and you're not stressing out. All right, when you're doing a purchase in an exchange transaction. Okay, so now let's just get down to the current climate that we're dealing with President Biden's tax proposals. And I'm going to focus again, like I said earlier, I'm going to focus on the word proposal. That's what it is. So as a part of President Biden's tax plan, he's talked about, originally he talked about, when he was candidate Biden, he talked about eliminating 1031s. That seems to be pushed aside for the moment. And now it's saying that, okay, we'll allow 1031s, but you can only defer tax on gain up to 500,000. That's the current proposal on the table for 1031s. Now, what does that mean? I don't know. I don't know whether the 500,000 means per year or per property. Okay, don't know, have no idea what that's going to look like. They're talking about increasing capital gain rates for high income earners. That if he's able to increase the capital gain tax rate up to where he wants to be, which is 39 point, I'm trying to do the math now, 39.6%. You have to tack on, if you're at the 39.6%, you're also going to be at the 3.8% for the net investment income tax. So that capital gain rate is going to be what? 43.4%. Okay, and then you tack on the state tax, like in California, you're looking at somewhere close to 60% in taxes if you sell a property. So now again, we don't know whether that's going to go through. If it goes through, whether it's going to go through at that rate or not, or whether it's going to be brought down to something probably a little bit more palatable. Okay, so we'll wait and see. That's all being proposed at this point in time. I will tell you, as an industry, the 1031 industry, we have our own little what I want to say here, our own little trade group, if you will, the Federation of Exchange Accommodators. We've been monitoring this for, like I said, since he was candidate Biden, and we as an industry, along with other real estate industries, National Association of Realtors, ADISA, the ICSC, basically the alphabet soup in real estate, are all lobbying the people in Washington that are on the House Ways and Means Committee and the Senate Finance Committee about the importance of maintaining 1031s. Because while they're looking at 1031s to cover what's known as a pay for, okay, the reality is if 1031s either are completely eliminated or capped, that's going to have a major impact on not only the real estate industry, but all the other ancillary services that support the real estate industry. So in essence, you may not be getting the revenue you thought you were going to get if you eliminate it. So that's the overview. I would say just as good citizens of the United States, just be aware of what's going on in this. If you make your voices heard to your local, to your representatives, House and Senate, and say, keep 1031s, leave 1031s out of the picture, and don't raise any capital gain rates taxes either. And definitely try to keep the estate tax, the step up in basis is something that's available. So anyway, so that's the presentation. So Evan, do we have any questions?
Yeah, thank you so much. That was extremely helpful. So there's a few questions I see. Here's a question for you, Dino. I have a duplex. I live in one unit, so of course that's my primary residence. The other unit is a rental. Can I sell this duplex and use a 1031 for the situation?
The answer to that is yes. So what would happen in that circumstance is the unit that you're occupying as your primary residence is going to be excluded, okay? So your tax person is going to have to come up with what's the percentage between the unit you live in to the unit that's an investment. So assuming the two units are equal in value, both for square footage and internal stuff, that means that if it's 50-50, only 50% is coming into the exchange. If the unit you're living in is larger and more valuable, and more is weighted on that unit, then so say if it's 65-35, then only 35% is coming into the exchange. Okay, so yes, it's called split treatment, so that can be done, but you want to make sure that you're talking to your accountant to know what those percentages are, because when you enter my world, that's going to be the question I'm going to be asking. What's the percentage? And it's not something I call out, it's what the accountant's going to say. Okay.
Yeah, great question. And I think that's, let's see if we have any more here. Here's another one. Any special concerns exchanging Texas property into Nevada, Oregon, or Washington properties?
Okay, good question. The answer to that is no, because the codes are federal. Okay, Texas is a non-income tax state, so that's easy. So there's no state quote unquote issue there. All right, so you can exchange anywhere, U.S. property for U.S. property. The states that the one state that does not comply with 1031 is Pennsylvania, and then Georgia has a nuance, which is where I think you have to stay in Georgia to not pay the Georgia state tax. California, for example, mirrors the 1031. And the reason I bring up California is because if you exchange California property for property outside of the state of California, there's going to be a filing requirement every year on your tax returns. It's the FTB, so Frank Tom Boy 3840 form. You have to let California know you still have those properties, okay? Because you're deferring California's state tax. And so California says, California's always had a clawback provision, which basically means if you sell outside of, if you exchange California property, defer California tax, and then say, for example, you go buy in Texas, and then say, for example, you move to Texas or you're a Texas resident, well, you still technically owe California the tax, okay? So California has the right to claw back the tax on the gain earned when you sold out of California. Now they never had a way of monitoring it. In 2014, they have a way of monitoring it. I don't think, there may be other couple of states that have something similar to that, but California definitely does. Okay, but so the two states for sure, Pennsylvania doesn't recognize, doesn't mirror 1031 code, and Georgia has its own special nuance about exchanging within. But you may want to check, like I said, just check to make sure if you have to fill out any kind of holding waivers or whatever to the local states.
Awesome. All right. Well, thank you so much, Dino. I appreciate it. I kind of just want to recap real quick. If you guys have any other questions, feel free to either reach out to myself or Dino. She had her information there on the last slide. But I also kind of just wanted to dive in just quickly, kind of what you can expect from an advisor, which is obviously my role here. There's a lot of moving parts in a real estate transaction, and it is just crucial to meet with an advisor, either myself, and kind of figure out the goal settings, get a roadmap together, and figure out, you know, your best options. We want to give you options, and we want to make sure that you have these options up front, so that we're not, you know, day 29 we close day 30, and you know you're going to be hit with like a huge tax bill. So extremely important to get this on a roadmap and figure out our options. So that's what you can expect with an advisor here. And lastly, we have a ton of educational videos and articles and how-to guides on our website. To go there, go to marshallreddick.com and then go to the Learn section, and we have just a boatload of past webinars and articles and just really good information, such as this one, you know. So feel free to utilize that. And lastly, my favorite is obviously the ebook. I'm not sure if you guys have maybe had a chance to look at that, but if you're interested, send me an email and I could send you a copy of it. But basically, it just dives extremely deep into the property classes, you know, such as A to D class, and explains the pros and cons of owning, you know, a D class compared to an A class. I will say I own properties in each of those asset class, and I wish I would have had this book prior to investing. So definitely worth a read in my opinion. So and lastly, that is pretty much it. That sums up our webinar today. And I want to say thank you again for Dino. Thank you for having us be a part of this. And if you guys have any other questions, feel free to reach out to us. All righty. Well, thank you guys. Have a good one.